Well, the first story of the week is about how everything else is going to go down, Steve. It's that 11 grand or so you've got sat on the side. Maybe you should consider running out of some other things as well. What do you think?
Yeah. So really, this piece of the podcast has sort of stemmed from. We've had a lot of noise this week. Is really essentially what it's been. We've had sort of prominent voices in both banking and central banking, and really from all sorts of sort of prominent investors, just to warn about the so-called artificial intelligence bubble, warn against the explosive growth, the companies that are powering it, and I think it's created what I would describe as a divide among the sort of investors and industry leaders. And the one side is saying, look, this is unprecedented economic growth, and the other one is saying, look, this is textbook financial stock market bubbles. So what I thought I'd do is I just collate what everybody is saying about the market at the moment, and what they think is going on, and what they think is real and what they think is not real. And I think there'll be some surprising people on sort of both sides of the spectrum for people here, because I was surprised that some of the voices are saying some of the things that they're saying. So see what you think, and we'll we'll come to a conclusion. Steve and I give our opinions, and obviously we'd be really welcome to your opinions in the comment section as well. I'm going to start with Jeremy Grantham, Steve. You will not be shocked to hear where Jeremy Grantham sits on this. He is extremely bullish. No, I'm joking. He's extremely bearish. He said this is essentially the dot-com era on repeat. He said it's an AI frenzy, is what he called it. It's a classic bubble within a bubble, warning that the hype surrounding truly great technology guarantees overinvestment in an inevitable and brutal correction. He said that Nvidia are essentially the guy selling shovels at the peak of the gold rush. So yeah, that was particularly interesting. Jeremy Grantham, that's his sort of standard reply once PEs get above 15. So that's not a massive surprise to me. Here's one that will surprise you, though, I would say, Steve. Sam Altman, CEO of OpenAI, he said that there's a lot of potential in AI, but acknowledges that there's a lot of hype. He said that, are we in a phase where investors as a whole are overexcited about the potential of AI? My opinion is yes. So he said that obviously a cycle of booms and busts is natural for transformative technology. He doesn't think AI will be any different. So I would have him in the cautiously warning sort of section. Let's go to David Solomon. David Solomon is the drummer at Goldman Sachs, or the DJ at Goldman Sachs, also the CEO occasionally. He said there's going to be a market drawdown, essentially. He thinks we're heading towards a market drawdown. He avoided the word bubble, but he didn't avoid the word risk. He said that he would expect an equity drawdown in the next 12 to 24 months. He believes that a lot of the capital that's been deployed into AI stocks is not going to deliver returns, and because the market is run ahead of commercial reality. So yeah, that was quite a shocking one. And we'll go with Jamie Dimon next. He said that he thinks we're in an early phase. So he thinks, from what he's seen, long-term AI is going to be a success. He's certain about that, but he thinks it's going to be painful for people who buy high. In his statement, he said that AI in total will pay off, but he warns that people buying at peak valuations are going to lose money, which is a common pattern in the speculative phases of technological shifts. Shuffling on to Andrew Bailey, Bank of England. He said pretty much the same thing. He was skeptical of high market prices at the moment, and warned that the AI boom, the AI shift, appears to be in a bubble. And obviously, he was warning that bubbles do pop. I found a few people who are still bullish, but not an awful lot, Steve. And again, I'm not going to shock you by with the first one. The first one on the list is Cathie Wood. She said that she's hugely bullish, is the word she described it as. She said the technology is in its very early stages. AI is the most significant big idea that's driving what she called technological convergence. she thinks there'll actually be massive exponential growth rather than a bubble burst, and she thinks the market is severely underestimating the productivity gains that AI will drive in the sector. Where have we heard that before? I'm not sure. Jensen Huang is also he described himself as fundamentally bullish. So he's the CEO of Nvidia. He said he's focused on the necessary infrastructure investment. So he's essentially the head of the sort of indispensable part of AI, the GPUs. And his view was that it's essentially a massive requirement that's required for a new foundational computing paradigm, is how he worded it. He said that sustained fundamental demand for AI infrastructure suggests that the current cycle isn't a bubble, but it's more of a retooling. Which, you know, he's the guy looking at the numbers, Steve. So, and I mean, we've looked at Nvidia's numbers enough to say there's some reality to these revenue figures. It's definitely showing up in Nvidia's top line. So, look, I think the debate's going to boil down to whether the long-term technological reality for AI can survive the speculative short-term pricing. I think that's kind of how bubbles become less bubbly, I guess is how I'd describe it. I think everyone agrees that AI is improving. It's actually better than we expected. And I would say that really you've got to think, it boils down to one question for me. So are you as an investor valuing the next 5 years of revenue or the next 50 years of potential societal transformation? And I think if you're in the second half of that, you know, good luck to you. But that's a bit pie in the sky stuff. It's a bit like the bull case that ARK used to put out, where they would say, you know, I don't even know what stock they were at the time, like Teladoc will be £15 billion a share. And that was just that was the bull case, because everything was just going to go massively great, and that's all great, and everything's going to be great. And that's not necessarily the case. So with technology, what tends to happen is, especially transformational technology, is that the early adopters sort of push the narrative a little bit, but they don't all survive. So even taking a basket case of investments in this sector doesn't necessarily mean that you'll have any in there that go on to succeed. If AI hits a stumbling block and it needs massive investment, and we hit an economic downturn, those companies won't be able to get their investment. I mean, OpenAI is one example, has got nearly $500 billion worth of spending planned, with up to 3 trillion more to follow it. Well, they don't have anywhere near that level of cash. They might have a fraction of that cash. So where is that cash going to come from? And that's a question that you've got to ask yourself among all of the companies. Now, I don't think the Googles, the Amazons, the Microsofts, etc. I think it's quite easy to plot where their money's going to come from, but it's the others that are the issues, I think. So yeah, I think we're either heading for a inevitable market correction, or prices are too cheap, Steve, for what is coming. But I would always edge, for myself anyway, to be on the side of caution. So I'm not ready to say a bubble. I think I'm kind of in this sort of Jamie Dimon camp, but I think a lot of the smaller, no cash flow, no profits, no chance of profits companies are trading on the high side of what is probably responsible for an investor who is trying to preserve his capital and not just swinging for home runs at every pitch. So I would. That's where I would sit at the moment, Steve. I know it's a bit fancy, but where are you on the matter?
Bubble. But slightly cautiously, I don't care what ARK say, to be honest, on this subject. I do care about what Jensen Huang says, and there's elements of talking his own book, but I think he has more than enough credibility built up in the context of talking his own book that he deserves to be taken seriously when he says this is in an early innings. I was listening to someone else, actually, this week, other than the names that you mentioned, talking about NVIDIA, AI, chip stocks, all those kinds of things. On the Steve Eisman podcast, Steve Eisman is not an expert on chips particularly. He's very good on financials and well worth listening to on that. But He interviews quite a lot of people. He interviews some really, really good analysts, and also Dan Ives some of the time. But he had a guy on called Stacey Rasgon, who is a researcher. I might even be a partner, to be honest, at Bernstein, and he is outstanding when it comes to chip companies. I think the downer I've had on listening to him some of the time is that he does struggle a little bit to avoid talking in technical speak, which anyone who's listened to this show it will know is what puts me off semiconductors quite a bit. Steve Eisman is brilliant at stopping his guests when they move into technical speak and saying, what does that mean? Say that again. Wait, what's this thing? And so on and so forth. But Stacey Rasgon is generally someone who has certainly built up enough credibility with a long track record of being very insightful on these things to, again, deserve to be taken seriously. And here's his view on the subject, which I'm giving serious consideration to. So his idea is that AI as a industry as a whole is still in the first half of its development. It's nowhere near topping and coming off, but there are some kind of challenges in the near future, especially in the context of NVIDIA. And his kind of concern is that the market is sooner or later going to say, okay, we're spending big on all of these things, these video chips and so on and so forth. And where is the return coming from here? Because this isn't something he says, but as a background and a thing that I've been paying attention to, there was about, we go back 12 months or so, every company was claiming to be an AI something or other thing. We were counting the number of mentions of AI in transcripts, and in some cases that was kind of plausible, and in a lot of cases it was basically not. So I was thinking, and still am thinking to some extent, look, the worst parts of the market are not likely to be the companies that are not AI companies. It's going to be the companies that are pretending to be AI companies and not AI companies, because they're currently getting priced like they're AI beneficiaries, and actually it's either irrelevant or bad news for them. And you've been seeing that a little bit with the kind of software gets destroyed by AI narrative that we've been seeing going around lately. But what could go wrong in the near term for NVIDIA? Well, one is the market gets impatient, but Raskin doesn't think that's coming, at least not imminently, sorry. He doesn't think that's happening in the earnings cycle that we're in right now. Give it another 3 quarters, maybe a year, and people start to get fidgety and say, we're putting a lot of money in the ground here. Is there any chance we're going to see some of it soon? In the case of the hyperscalers, investors are actually well used to this, especially with Amazon. Amazon has long been a plant and then pause and then plant and then pause on whatever it is that it's investing in at the moment, cloud capacity. But elsewhere, there's a chance at some point people will get impatient if returns don't show up, and maybe justifiably given what's been said about it so far. He also said, if it is the hyperscalers that start saying, you know what, we're not seeing returns here, we're going to pull back this massive capex, NVIDIA's toast, pretty much. If the hyperscalers start backing out and saying, you know what, we don't need this, we can't see how we're going to sell this, demand isn't where we thought it was, that's going to be awful news for NVIDIA. And I think there's a lot of plausibility to that. So long term, he thinks there's still quite a way to go here in terms of AI, but some very important things to watch out for in the near future. I think it's a bubble because when I was talking with our new first years in PPE at Lincoln and Oxford, it's all they talk about. They are all across this stuff. They all have views, they all have ideas. I'm not saying I agree with them necessarily, but it is the thing that they consider to be the pressing issue of the moment right now. And I think whenever stuff gets that exciting, it's almost certainly overheated. Interestingly, though, Steve, from what you were saying, I was looking at the data from the Bank of America Fund Manager Survey. This is now a month or so, 3.5 weeks old. It comes out monthly. The next one's due sort of in the week coming up after we record this, about what fund managers consider to be the biggest tail risk, which is to say biggest risk of a crash. They list 5 things here that get some at least meaningful votes for this. AI going bust is number 5 on the list. Here's the things they are more concerned about in the immediate future, or at least were nearly a month ago. This may change in the week coming up. They may all be shifting towards AI bust as a potential catalyst. But 4 was trade war causes a global recession. That's actually been making its way back down. It was the number one in July and the number one in August, but it's still on the list and still high up. Three is unruly rise in bond yields. So bond yields rip higher. Two is the Fed loses independence and debases the dollar to about 24% of people. And the number one is we get a second wave of inflation from Trump tariffs. Second wave of inflation is what is written here, but that will be driven by Trump tariffs if it's anything. So about a month ago, people were only starting to come around to this AI thing, but you're right in certainly pointing out there's been quite a lot of attention on this in the last week or so, hasn't there? So it'll be interesting to see if this is moving up the list of things that people are worried about, because I'm not convinced that inflation is cooling off particularly. The trade war might go down a bit, but especially as the legalities of tariffs start to get explored a bit more closely. But there's more than one potential warning sign for the stock market. Not particularly willing to forecast a crash or anything, but it might be that AI is just sneaking up there a little bit.
Yes. So that was kind of the key sort of message from Bank of England Governor Andrew Bailey. So he was talking about it in terms of optimism. So he was saying that at the moment, the market is very optimistic about a lot of things like AI and quantum computing and technology to a certain degree, or the technology stocks. And he was saying if that optimism dries up, that's when you're going to hit the problem, because you saw how a large swathe of the tech sector changed direction pretty quickly when the market told them, you better show us some bottom line stuff. We're getting sick of this, growth at all costs, just losing whatever you lose, kind of thing. And everybody, or the vast majority of the tech sector, changed tune overnight. And Steve and I were reporting just the next quarter how there'd been huge layoffs, and they'd started to they'd all started to make money, which was quite shocking. So I think that's kind of the overarching message, is that when there is optimism to this level, you've got to try and figure out if that optimism is sustainable. And that's where I would fall on the side of, I'm not sure. I don't think so. And that's why with things like quantum computing, I'm just staying so far away from, not that I would have a hope of understanding anything about quantum computing. But yes, that would be the reason that I stayed clear of it. The other thing he said was that it could yet deliver for investors, but his worry was that the sheer scale of investment in the sector, essentially the hundreds of billions of dollars of money that's getting piled into them, has created heightened risk should it not pay off. So he thinks that if it doesn't pay off, because of the sheer amount of money that would get trapped within this investment at the moment, you would essentially see everything start to tighten up, including stock markets across the globe getting caught up in it, and lending seizing up as well. And that is a worry. If money starts getting trapped in places, especially big overvalued places like this happened to a degree in the housing market during 2008 when people were buying houses, highs with big mortgages, and then obviously the crash happened. Money got stuck in negative equity, and that obviously made the lending part of the market seize up as well, and that made it harder for people to get loans. And obviously that the greasy wheels of the economy lose the grease at that point, I guess. So that's the shock. That's what could happen, I think, is or the most likely scenario in my head if it goes wrong is that problem, essentially oversupply, maybe underutilization, leading to money being trapped, leading to poor investments, leading to your Amazons, your Googles, your et al. Pulling out of that kind of level of investment, which would drive Nvidia down. That's kind of how I map out the bear case in my head. Not that I necessarily think that's exactly what's going to happen, but in my head, that's how it plays out and that's how it goes wrong. So, that was just Steve and I's thoughts on it generally. But we'd love to hear what you guys think about it. I've seen a lot of people talking on the Trading 212 forum about it essentially being this virtuous circle of people giving money to Nvidia and Nvidia investing it in some company like OpenAI, who gives some of the money to Oracle, who goes and buys the chips for Nvidia, and it's become this kind of like circular economy between them, and that is interesting. But in those things, I think people tend to miss out the Amazons and the Googles and where those two get their money from, and that kind of makes it more like a money vacuum rather than just a circular economy of passing money around each other. But yes, give us your thoughts in the comments. We'd be really interested to hear it.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.